Hi everybody, in this video we are going to look at gold miner financing because projects need to get financed, and we are going to look at the impact on the upside and the leverage. For this video we are going to look at Newcore Gold as an example. This is a PEA stage development project in Africa, and capex is around 100 million, production around 100,000, a little bit more of that. AISC 1,200, construction time 2 years. So looks like a good project with a lot of cash flows coming in, going to 700 million, NPV 10, and the current market cap is 100 million US dollars. So the upside at current gold price is about 6x, okay? 500%. If it goes down, then it's still a double. If it goes up to 5,000 gold, then we have a 10 bagger, more than a 10 bagger. So we're going to look at different financings, debt, royalty, and PP, which is private placement. Okay, the first one is debt. That's really easy because you get cash and you have debt. So your enterprise value doesn't change. Only interest needs to be paid. So let's say 15% interest, 15 million, because you need to pay interest on the 100 million cash. Some construction still need to pay because you didn't pay it off. And in the first year, apparently, you get 160 million free cash flow. And you can pay off the whole debt. So let's say 5 million here and then 0. Okay? So the dilution is about 35 million here from interest. So this was the situation before. And now we have the situation after. Let's take a screenshot. This is the debt financing. Let's put it here. So this goes to 1,000 at 5,000 gold. And it was at 1,030. So tiny bit lower. And here also a tiny bit lower. So actually the leverage looks quite good still. It's the same leverage, I think. But the whole curve just shifted a tiny bit lower. So I think debt financing is a very good option for Newcore Gold because they pay it back very fast. Second option is royalty financing. Let's delete the interest payments. For 100 million cash, for 1, 2, 3, 4, 5, 6, 7, 8, 9 years. I don't know how much I want to get paid, but 9 years, let's say this divided by 9 is I want to have at least 13 million in cash paid back. Let's say 14 million, because normally you would take even higher because gold price would go up and all of that. But yeah, you get mine life extensions, so the royalty is forever. So let's say I want to at least have 13 million per year. So that's about 3%, 3% of the revenue. Yeah, sometimes it's 4% of the revenue. Here it's 3%. Here it's less than 3%. So on average, let's say 4%. So 4%, that's 96% is what you get from the revenue. I'm going to do this the same as here. That's to create a leverage chart. And the same here on the revenue. Okay, what do we get? Also a tiny bit lower NPV. And here, let's take a screenshot. So this is the royalty stream. That is number 2. So what do we have here? 970% and 100%. So it's tiny bit lower. But at 2000 it's the same. So 2000 is the same, but here a tiny bit lower, 970, and here it's 1000. So the royalty stream reduces the leverage, basically. Okay? Royalty streaming reduces the leverage to the upside. If gold goes up, you will get less revenue because of that percentage that was deducted, the 4%. Okay, so that's royalty stream. It's about the same as the debt. Let's remove this and this. Okay, so now we are back to 700 million, and we go to the third option. It's dilution. We have 253 shares, and the price of the share price is 0.44. So if I need this amount of capex divided by 0.44 shares, dollars per share, then I need to issue 241 million shares, right? So I'm going to issue 241 million shares, and I deduct that from the enterprise value. The cash that I get is 106 million. Okay, so enterprise value should not change. It's still the same, 100 million. But the share count has more than doubled, or yeah, it has doubled. So what effect will this have on the upside? I'm very intrigued to see it. Amazing. This is very amazing. Look at this chart. I'm flabbergasted. I have no teeth left. Look at this. 50% to 530%. And we were coming from 1000% and 120. This has been cut in half, and this has been cut in half. So basically, this has been cut to here, and this has been cut to here. So leverage is down, yeah, because the slope is down, and also the upside is down. Okay? This is amazing. So it's clear to me, absolutely clear, that the best way to finance is debt or royalty streaming. Yeah, depending, of course, on what the streaming deal is. It could be that they want more money like 5% or 6% royalty stream for only 160 million. But depending on the deal, I still think that streaming and debt is better. Debt, of course, is very good because you only lost 35 million in NPV with the interest payments, because you're going to pay off the debt in just 1 year. So that is actually a very good way to do non-dilutive financing. You retain your upside. It's basically just the same as without debt financing. Basically just the same upside and leverage. And compared to dilution, issuing double the amount of shares. So you doubled your amount of shares at this share price to get 100 million capex, the cash that you got here, minus 106. You have the cash, but you had to issue 200 million shares. And your market cap doubled to 200 million. So your market cap is now here, 200 million. So the upside is much less now. It's only, how much is the upside now? Only 250%. Okay. So why are people doing private placement financings instead of debt? Well, there is one advantage because you don't have debt on the balance sheet, and people like to see a clean balance sheet. It reduces the risk, so you can't go bankrupt, etc. If you don't have 100 million in debt, your market cap was 100 million and you have 100 million debt, that would be, yeah, investors would not like to see that, and it's quite risky. If it doesn't work out, you could go bankrupt if you can't pay off your debt. So there's a risk involved with debt financing. So this has a risk to use debt, but it's non-dilutive. You can see that here. With royalty streams, it's the same. It's basically also non-dilutive. The slope went down a tiny bit to pay for the 100 million upfront cash. But basically, this is also non-dilutive. The leverage is still there and the upside is still there. And it also has no risk because you have no debt. So royalty streams are actually the best of the best to do. You have no debt risk, you cannot go bankrupt, and there's no dilution. The slope is still steep and the upside is still 500%. Private placement, no risk, you have the cash, but look at the slope, it's completely down, no more upside. So conclusion, the best way to finance a project is with a stream. You have no risk of bankruptcy and you have basically no dilution. You still retain your upside. And that was this video about, and I'll see you next one. Bye.